Good morning again, everyone. Good morning again this morning. Can y'all hear me fine?
Good morning. Yes, sir.
All right,
Yes.
cool. Cool. So we're going to go over what we're going to go over in part two today, but then we'll review part one and then we'll get into part two. Part two is going to be two. We're going to talk about the other two reasons to take a trade, right? And we're also going to talk about market structures. All right, so that's what we're going to go over in today's session. And I don't know where that went, but I won't worry about it. So let's do it again. Part two. We're going to go over the other two reasons. Take a trade. And then we're going to go over market structures. That's it. So let's talk about part one and get review, right? In part one, it was Carmen and I on live last time, but in part one, we discussed the seven things the market can do, which is a higher high, higher low, lower high, double bottom, double top, and reversal. In part one, we also talked about the types of reversals. There are four of them: the ABC, the 1, 2, 3, the 2B, and the 3-bar reversal. And in part one, we also went over two of the four reasons to take a trade, which was a higher low and a lower high. Okay. Today's session, we're going to go over today's session, we're going to go over part two. And those are going to be the other two reasons to take a trade,
Which was a higher low.
and add another person to join. If you could go on mute for me, Genesis. Thank you. Uh, then today's session, what I'll do is I'll go ahead and restart. I know Genesis just got on, but I'll restart and kind of go over Genesis. Last week we went over the review for part one, which were the seven things the market can do. If you didn't
Again, everyone.
if you didn't take if you didn't have a chance to look at that video, or if you did, this is a review for the seven things the market can do, which is the higher low, lower high, double top, double bottom, and reversals. And we went over the four types of reversals, which were the ABC, the 1, 2, 3, the 2B, and the 3-bar. And then part one, we also went over the two of the four reasons to take a trade, which was the higher low and the lower high. If you can put that in your notes, you can have that for later for review. And I'll talk to you guys one-on-one offline after the training session today. Today, we're going to go over the other two reasons to take a trade, which would be, and write this down. I'm going to type it in the thing here. The other two reasons to take a trade one of them would be a divergent lower low, and then a divergent higher high. Okay, that's it. Now this is interactive, so if you guys want to ask questions, feel free to, but just go on mute if you're not asking a question. So this is interactive.
Well, first of
Uh,
all,
Good morning, everybody, and I wanted to welcome our guests, our new team members, or the young ladies that I see, uh, and say welcome to the team.
Thank you.
So, all right, thanks a lot, Quentin. Uh, so that we'll go over the divergent. This is the divergent lower low and the divergent higher high, the other two reasons to take a trade, and the market structures. So I'm gonna put Keith on the spot for me. Keith, you should know this, I hope. Can you tell me the type of market structures? Because I'm going to type it here for everybody so that we can kind of get input from everybody besides, other people besides me. So do you know, can you tell them to me?
Market structures, you got a higher high.
So you got a higher low, higher high market
Yeah.
structure. Hold on a second. Let me type
You
it
want
in.
you want all the market structures, just the reason to take trade market.
No. The market structures, like
Okay. You got a market structure, higher low.
okay, market structure. All right, let me type it in because I can't type as fast as you can talk. Hold on 1 second. So I got a market structure, higher low.
Mm-hmm.
Uh-huh.
Market structure, higher high.
You got a market structure, higher high. Okay.
You got market structure, lower low. Market structure, lower low.
Market structure, lower low. Okay.
Market structure, lower high.
Okay.
Okay. And you got double top, market structure, double tops and double bottoms.
All right, I got you. Okay. And what about and one you missed, I'll tell you, the inside bar. I know we don't talk about them much, but the inside bar market structure. And put the market structure, double tops. Market structure, double bottom. And then you got a market structure that's a inside bar. I said inside. Okay. So those are your market structures. And we're going to go over and talk about all of them today. So the two reasons to take a trade, the divergent lower low and divergent high high. What we're going to do is we're going to go over how do you define divergence. So let's talk about that. Because if you don't know what divergence is, how you going to know how to look for a divergent higher high or divergent lower low? A divergence is when price and the indicators are doing opposite things. Again, divergence is when price and the indicator are doing opposite things, i.e., for example, the indicator is making a lower low, but price is making a higher low, or price is making a lower low, and the indicator itself is making a higher low. And what I'm going to do is now I'm going to add into here that's not the one I want. Hold on a second. I want to add my indicator here so that we can go over the divergence. That's the most important thing. Let me move this over here so we can see it here. We're gonna go over divergence first, right? So what I'm doing now is I'm looking and I'm going to get out of this area so that, does everybody have that written down? If you need more time to write this down, let me know. If not, if I don't hear anything, 3, 2, 1. I'm moving so we can look at price and look and find some divergences so you can see what I'm talking about. I see one here and it's clear as day. So now this is an example, right? Price made a low here and it made a lower low here. So it went lower here, right? So price went down. However, if you look at those exact same 2 points, the indicator made a higher low there. So price made a lower low. The indicators made a higher low. So price made a lower low, indicator made a higher low. Does that make sense? And if it doesn't, that's okay. I want you to ask questions because I want you to ask me questions so we can go through it kind of, I'm not going to say it at length, but so we can definitely make sure that you see that. Can you see where the indicator here made a higher low and price made a lower low? That is what you call, that is a pictorial definition of divergence. Okay. That is a pictorial definition of divergence. Let's see if we can find one coming from the top, and that will be a divergent higher high. Let's see if we can find one. And I want it to be obvious too. And we will scroll until we find one. Let's keep scrolling until we see a. That's one right there. I don't like it, but I'm gonna show it to you because I think that it does the purpose. This is here is an example of a divergent higher high. If you compare these 2 points, you compare these 2 peak points right here, they're going in opposite directions. So when that happens, you have a extremely high probability that price will then go in the opposite direction, meaning down in this case. If it's divergent higher high, it's probably going to go down. If it's divergent lower low, it's probably going to go up, right? So those are the 2 kinds of divergences, right? And those are reasons to take a trade. Those are the other 2 reasons to take a trade. When you have a divergent higher high or you have divergent lower low. So I gave you 2 examples. Does anybody need me to do any more examples or have any questions that they might have for me right now?
But just to clarify, when you do see that, like you just drew there, that if it's that way, if it's a divergent higher high, then there's a good probability it's going to go into a downtrend or down.
Oh, it's going to go down. Correct. That is absolutely right.
And then vice versa, if it's like on the other example, if it's a lower low, then it's a good chance it's going to go up.
Go up. Correct. Like in this example here, you can see the divergence.
And then it does it, and you see it clearly go up.
Right. Right. So that you have it's extremely high probability. And when you have confirmed, and when you have divergence going from the top to the bottom or from the bottom to the top. So it's pretty high probability, right? The next thing we're going to do is go over market structures. Okay. I am going to expand this chart out a lot. And we're going to talk about market structures. Right. So when you talk about a market structure high, right? When you're talking about market structures high, in this case, I'll use this example. You see this bar has a high. Then this bar has a higher high. When the price breaks the high of this bar, let me use my tools and get my arrow here. When price breaks the high of this bar right here, then you have what you call a market structure high, right? So, and I did it wrong. Let me move the drawing so you can see it. When price breaks the high, you have one high here, you have this high here. So when price breaks this high, now you have a market structure to go up. And here's a firm way to look at this. When market structure happens to go up, momentum is also considered to be up. Let me show you what a market structure down looks like. Market structure down, as far as the market structure low is concerned, it's the exact same thing. You have this low, and then you have this low. When price then, go back to my tools, breaks this low bar here, when it breaks that low bar there, then you have a market structure going to the downside. When it does that, you have a high probability of that momentum now being down and it continuing to go down to some degree. So that's the market structure high, and that's the market structure's low going down, right? Now, let's talk about the inside bar. And I'm going to find a bar that's an inside bar, and I'm going to highlight it here. The market structure that's the inside bar is here. This bar here, I'm highlighting it and I'm trying to make it big so you can see it. This bar here is inside, and let me do it this way because you can't see it. So let me erase that and then put an arrow, right? But you see the bar that I'm talking about here. So let me erase that. And then let me give it an arrow here. That bar there, the bar right there, is inside the previous bar, meaning that it has a lower high than the previous bar and a higher low than the previous bar. That is an indecision bar. And essentially all that means is price is indecisive as to which direction it's going to go. But the probability is based on the color of that candlestick, right? Based on the color of this candlestick, and we'll get into that too. That's going to be a bonus that I'm telling you guys about later on. The candlestick here is red. So this inside bar turned red. So you have a high probability if it breaks the low of this inside bar, it's going to go down. And this is exactly what it did, right? We'll look and see if we can find an inside bar that's green. We'll look for one of those. Oh, this is a green inside bar. This is a green inside bar. Here, let me draw an arrow. Here we go. This bar here has a lower high and a higher low than this red bar, and it turned green. Now, this is how this worked, and I think this is very interesting to show. You see how then price made a lower low and a lower high and turned red, but the next bar it turned green and it took out. That's what you call a fake out. That's a little bonus information for you right there. That's literally called a fake out because that inside bar, this bar here turned red, faked everybody out, got everybody scared, and then it took right back off to the upside. And that happens often. And I want to look for another one where it actually does what it's supposed to do because we want to look for a green inside bar that this here is a green inside bar. Doesn't look like it, but I think that it is. Nope, it's double bottom. Double bottom. So that's a double bottom. So hold on. Looking for a green inside bar. That's another green inside bar. And as you can see, it went up from there because that green bar here, again, let me draw the arrow. So if you look and see here, see that? Then the inside bars has a higher low than the previous bar and a lower high, and it turns green, and then it shoots. It goes up. This is a consolidation because it really doesn't move anywhere. It goes up and it comes down and it goes back up, and then it shoots down and then it goes back up again. So it really, that's kind of a consolidation area. But those are your market structures. We also want to go over the double bottom and double top. And I saw one and then I scrolled past it. So let me see if I can find it again. Because I want to go over them in.
Can I ask a question?
Yes, sir.
On that inside bar that you show with the fake out,
Right.
is that considered an inside bar market structure?
Yes.
Even though it didn't. Okay. So inside bars, I thought they depended on the next bar. It had to break the high or the low, depending on which way you were going. So
No.
since fake out, I didn't know. I was asking, would that be considered still considered a market structure? It was an inside bar, but the next bar went down. Unless it was an engulfing bar or an outside bar. Can't remember.
Right. So if it's an inside bar, it's considered a market structure because it's the next. If the next bar breaks up or down, it creates the market structure. Does that make sense? What I'm saying?
And I guess that's what I'm asking.
Yeah.
Okay.
Yes. Yeah. So if it breaks,
next bar has to the next bar determines what type of market structure it's going to be. Inside bar market structure, but it's
it's
going
an
to be
inside
a
market structure, right?
Okay.
Got it. So let's look for a double top and a double bottom. I'm looking for it. Those are sometimes harder to find, but we will
Just
find
past
it.
that green bars, you just passed one, a double bottom. Go back a little bit. Right there.
Yeah, you're right. Look at you. I'll see, look at you. Keen eyes, keen eyes. So, ladies and gentlemen, this would be considered, right? The double bottom, right? This is what you call a market structure. And when you see a double bottom, it typically is a reversal pattern. That means price is going to then, from a double bottom standpoint, is then going to go up, right? So from a double bottom perspective, you then see price go in an upward direction. Okay. So you see that. And then let's look for the double top. If y'all see it, point it out. I'm looking for it too.
And you said on that double bottom there, that's an indication which way the trend is going to go?
Well, price
Price,
price at that particular point, if you get a double bottom, price is typically going to go up if it breaks the high of the bar that caused the double bottom.
Okay, yeah.
So if it broke this high, it's typically going to go in this direction.
Okay.
All right. That's a good question, Quinn. I appreciate that. So that's good. And I'm looking for a double top. If somebody sees one, let me know. Because I for some reason I don't think this is a double top.
No, it's not.
And so, didn't you have a double top earlier when you were trying to find the inside bar market structure?
I had that double bottom.
The double bottom.
Yeah, I had the double bottom. And that's the one Quentin pointed out when we came through. Come on now.
Lower right there, maybe.
Right where?
Red and green bar.
Right here?
Further over.
Right here. You're talking about these two. That's close.
Next,
Hold on.
the next two.
Right, these two right here is red and green bar right here, right?
No, the next two red and green bar.
Oh, that is man. Y'all must have the glasses on because I didn't see that. That's pretty good, Keith.
The better one might be the other one if that's one next to it.
It's close.
Yeah, because the double top's supposed to go down. So if you look at
Yeah, and it didn't in this case. Because it didn't break the low, right?
but
So
to keep going over 7 bars, 6 bars, is that one can't to the
It's
right?
got a small stem on the red one.
That's why I can't. That's why I'm debating.
yeah, you can't see that one. So let's go to something that's a little bit better here. We went over that, went over those, went over those. That is amazing.
Right there. Nope.
Yeah,
Nah,
right.
missed about a tick.
But you do have a double top though. It's a double
Is it?
top, but it's let's see what it does. Is it gonna go down? There's a red bar right here, inside bar, then a double top. You see that? Right there.
That's a
Right
double
here.
top.
Right here. It is a double top. Right there. This bar and this bar. I was trying to find tweezer tops. Tweezer tops are nothing more than the bars that are right next to each other.
So they don't have. Yeah, I was gonna say they didn't have to be next to each other.
They don't have to be next to each other, but for teaching purposes, it's easier for people to see.
Yeah.
There it is.
Right there.
That's the double top, right? That's the one. And ladies and gentlemen, this one here, in my opinion, is like that's like you salivated something like that, right? Because when you get this market structure up, because you have an inside bar and it broke to the upside, and then it gives you a double top, and if it breaks this low, it has a gargantuan opportunity to go to the downside. I mean, that's almost a no-brainer trade there.
What else is there? If you want to pop quiz.
There you go, Keith.
So no, we're just going to stick to the double top. I mean, because we're just sticking to the market structures there.
Yeah, there's an
So,
ABC pattern. You talked about that already.
yeah. So yeah, we're not getting nobody no quiz today because they'll be like, look here, man, we didn't come here prepared for that. So yeah, but
Please.
those are your market structures, and those are your other two reasons to take a trade. So let's now go back and review what we talked about today. Right? Let's go back and review what we talked about today.
Keith, I can already see what kind of teacher you are.
Great one.
I didn't say you would.
Pay you for life.
So here we go. Right? Part 2. We went over, hold on a second, because I think I did that. Let me go back and rescale my reset. I don't like that at all. All right, so here we go. Today, we went over the market structure high, the market structure lows, right? We went over the double tops and double bottoms, and we went over the inside bar. We also went over the lower lows, the divergent lower low, and the divergent high highs, right? As a review, and continue, to go over that review again. In part 1, we went over quite a bit, which was the 7 things the market can do. which is there, the reversals, which are there, and then the two of the four reasons to take a trade, which is the simpler reasons to take a trade. So we've gone over all of those things. The next class we have, we're going to be putting this all together, and we're going to talk about multiple time frames and how you put that all together for a trading plan and to put the probabilities in your favor, right? That's what we're going to do next. As a matter of fact, let me go ahead and show you this. I talk about the candlestick bars because these are what you call candlesticks. But in trading, right, this is bonus material, not anything extravagant, but something for you to kind of sink your teeth into. You have candlestick bars, but you also have, I like to mess with people with this one. You ready? Watch this. You have some people who trade on mountain charts. That's what you see on CNBC and all that kind of stuff. You see, you see the mountain charts. You also have those are high, low, and close bars.
Say that
Right.
again.
Those are called high, low, and close bars. You also have, these are just the popular ones, right? That's something that people use. You also have point and figure. And point and figure looks like such. Oh my goodness. They disappeared. Hold on. Those are wrinkle bars. Wrinkle bars are nothing more than candlesticks without the
Damn.
structure for the most part, right? And then that's it. That's it. So those are your four main types of charts: your bar charts, candlestick charts, mountain charts, and also your wrinkle charts. So with that being said, that is class for today. And
Record.
that, what'd you say?
You record the session?
I did. It's on YouTube.
Oh, we
Yeah,
on loop. Okay.
yeah. So it's live on YouTube. So so it is that. And please tell me, are there any questions and or comments for me right now? If there is not, I'm not going to hold you ladies and gentlemen any longer. Just let me know. I'll give you a couple of minutes just to make sure.
Nah, that was pretty good. I don't have any questions at the moment.
All right, cool. So, well, if that's it, Genesis, you got any questions? Carmen, you got any questions?
I don't have any questions. Thank you.
Oh, absolutely, Genesis. It was good talking to you. Good seeing you could come in today.
Of course. I
All
didn't
right.
have no plans this morning.
All right, cool. All right. Well, we'll talk to you next time, okay?
Okay.
All right. Bye-bye.
Bye.
Carmen, you got anything?
Not at the moment. I mean, I'm gonna go and rewatch it again and take some more detailed notes, but I don't think I have any questions currently for you.
Okay. All right, cool. I just want to make sure because I'm like I was trying to hit the button, but I didn't get on there. Okay, cool. So all right. All right, if that's the case, everybody, we're going to go ahead and call this today. And you guys have a very, very happy new year. And I will see you.
Don't forget
I'll talk to
to
everybody later on today anyway. So I'll just see you guys a little bit later on.
don't forget to subscribe to the channel, and you can also ask questions at support@theprofitstalker.com.